Hi, everyone. This is Bruce at Fleet Capital Management. It is Friday afternoon, the 30th of September, 2022. Today was the last trading day of what I would call a crappy week, a crappy month, a crappy quarter, and a crappy year to date. Other than that, everything's fine, but the market has just been brutal. And we're going to take a look at the charts and see what they say and see what we might expect. As always, we need to say that this video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. Please feel free to subscribe to this YouTube channel. And as always, whenever you have questions, Bruce, fleetcapitalmanagement.com, and I will answer those for you. Homepage of our website makes it really easy. If you can't remember or the link isn't working for the weekly market video, you can always go here and all of them are stored. Also, if you would like to schedule a Zoom meeting with me so we can do a one-on-one and discuss your finances and your portfolio, I'm always available and happy to do that. Okay, let's get into some charts. Let's go scroll over to our trend matrix first. And in the trend matrix, and this is updated for today, again, we just have a sea of red. One of the new things that I've added, I don't know if this is going to help you, but it helps me, is notes on just any events that happen. Like on this particular day, there was a hawkish Fed talk in Wyoming, which pretty much crashed the market. On this day, the Fed raised 75 basis points with hawkish comments. They could raise, just so you know, they could raise 75 basis points, which seems like a negative, but then in their comments following, they could say, we think we're done. And that would be just hugely bullish. On this date, which was the 27th, the S&P begins a test of the June low. I'm going to show that to you. On this date, which is today, the S&P and NASDAQ 100 closed lower than the June intraday low. So I will show all of that to you as we go through the charts. Just a reminder, during a bear market, we now have multiple systems that we're using to try to take advantage of that bull market and make money in it. We have our 21-day S&P 500 option, which trades long or short, just depending on what direction the market's going in. It's based on signals. We have a 7-day SPX or S&P 500, does the same thing, just a much shorter duration. We have the WOA, which is long and short on stocks. This is not on the index. This is on individual stocks. We have index ETFs that will trade in bull markets and bear markets, and these are mostly leveraged. We have one trade on right now. I'm about to add a second, and I'll show you that. We have bullish ETFs. That list has expanded to 40. It does a great job covering the markets and much of the world, actually. And I've got alerts set up. If anything is working in there, it will alert me. And then bear stocks. One thing I forgot to mention on bear stocks in the last video that I made was these are not available for IRA accounts. This is only for non-IRA accounts. So as this starts to kick up, I'll be contacting you. I won't do it first, and I won't trade it first. And I will be seeing if you have a non-qualified or a non-retirement account. If you want to participate in bear stocks, then I'll put you on the list for that. But again, I will not make these trades for you until you and I talk. So that's our general trend analysis. Now let's go over here and look at our go, no-go charts. This is the S&P 500. Each bar is 1 day. That gold line is the 50-day moving average, which is an incredibly important line. And when we come down here, here is this week. This last bar is today. It's Friday. We're going to talk about that. But before today, we were trading above that intraday June low, which is right here. And that's what I have this green and red line marking. It's green when it's acting as support. Now that we've broken through, it acts as resistance. That's how support and resistance work. But prior to today, it looked like we were just kind of swinging all over the place, but in general going sideways. And that started to look like a consolidation phase. It wasn't very long in duration. It was only 4 or 5 days, but it started to look like a consolidation. Generally speaking, in a consolidation, down here in this momentum graph, we'll start to get this buildup. This buildup of gold lines is really showing what we call a squeeze. And a squeeze is very similar to a consolidation, but it just has a few different characteristics. And if it gets to a squeeze to where we start getting up into these top levels, then what we're looking for is which direction does momentum break? And it's usually pretty strong. This broke to the upside, and you can see it broke to the upside pretty significantly. So that is another indication of a trade. If we, on the right-hand side, we have, actually, I apologize. Let me go back to this left-hand side for a second. Here is today's bar. That little tick, and maybe I can make it easier for you to read. That little tick is the close. Yesterday's close closed on top of this intraday low for June. They all did. That's why it looked like support was holding so well. Unfortunately, today it broke down and it broke below. So that just means we're in a continuing bear trend until the charts change, and hopefully they will soon. But until they change, we're in a bear trend, and support did not hold this time. Over on the 60-minute chart, I want to show you something. I'm going to jump around a little bit, but for my 7-day options trade, this looked like a bullish indication where the white, the 8 moving average crossed above the 21 moving average. Why didn't we take that trade? We didn't take that trade because we're in a downtrend, so we're not going to take a bullish trade. And it's a little bit hard to see. There you go. You can see it now. We are below the 200 period moving average. So just helping you understand signals a little bit more. Even though this is a bullish cross or a bullish signal, it was not confirmed by anything else, which absolutely must be for me to take a trade. And we were below the 200-day moving average. So that's why we didn't take it. Now, the next day was a bearish signal. It was the 8 crossed back below the 21. Almost, and everything confirmed it. The only reason I didn't take that trade, and this is on a 60-minute chart, is because it looked like we were going to hit support and then bounce. So again, we always look at support and resistance. We want to see where we are, where the price is in relation to that. You don't want to trade a bull trade when you're sitting right under an area of resistance, and you don't want to trade a bear trade when you're sitting right above support. It just doesn't make a lot of sense, because more times than not, greater than 50-50, support will hold and will ride back up, or resistance will hold and will come back down. So we're always just looking for a preponderance of evidence. So we are still in a fairly strong downtrend. I do hope that breaks soon. There are some reasons to believe it will, but we'll figure it out when it comes. Going over to my 80-yard chart, this is one of my primary charts. The way I've done this is the red dash is the 200-day moving average, and the 50-day is this gold dash. I put those as dash so they'll stand out, because my short-term indicators, which is what I trade off of generally, the white is the 8-day and the blue is the 21-day. That's the only thing that's new on this chart. You can see here where we broke below. We are still below the bearish ATR levels. The 21-day is above the 8-day, which is still confirming a downtrend. We are under the 50-day moving average, downtrend, and we are under the 200-day moving average, downtrend. So there's nothing on this chart at all that looks uptrend to me yet. Things can change. Let me just give you a little insight into technical analysis. Yes, we did break, but let's say next week, Monday, we go right back above and the support holds, and that's when we start to go up. Then, you know, we always allow 1 day, 1 bar, but I don't know what that's going to look like until Monday. I can tell you if Monday closes lower than that spot, well, we're not looking for it anymore. We're just in a more of a downtrend until it changes. But if it closes above that, and especially above this area of resistance, we'll give a little space or grace to 1 bar that fell below. But again, I don't know what's going to happen until Monday when we see that. Okay, let me show you a couple other little trend things, and then I'm going to go back. I'm going to show you a bear trade that we're in. This is one of my market timing graphs. This is not the S&P 500. This is a composite of 9,000 stocks. Actually, does it say how many they're tracking now? I don't see it, but it's about 9,000 or 9,100 stocks. So this is not just the Dow or the S&P or the NASDAQ or the Russell. This is everything. So it's just, and this company chooses to do that because they feel it's very representative. I will tell you that in this chart, it kind of looks like it is building in consolidation, but we just don't know yet. We don't have enough information. But I will tell you that everything else, and these are trend indicators, the buy-sell ratio down here, how many stocks are rated sell compared to how many are rated to buy. We're laying down here on the bottom. I mean, we almost can't even go any lower. If we look at the MTI, which is a combination of timing and a few other things, you know, we're way down towards the very bottom of what the scale even is. If we look at the RT, we're down. So everything is down, but everything looks down to an extreme, is my point. So you know, that's interesting. If I look at, I didn't make a copy of it, but if I look at Morningstar's valuation chart, we are grossly undervalued. Grossly, the market is undervalued, and everything I'm looking at suggests this market is way undervalued. Now, what does that mean? Does it mean we can't go lower? Nope, doesn't mean we can't go lower. The market can do anything it wants, but you have to understand that smart money out there, money that is looking to invest billions and billions of dollars, they want to buy when we're grossly undervalued. So eventually, and it feels like soon, but I don't know, but eventually the buyers are going to start to come in. And when the buyers start to come in, institutional buyers, there's only one thing that can happen with price. It has to go up because there's more buying than selling. And it's an auction market. If there's more buyers than sellers, the price goes up. If there's more sellers than buyers, the price goes down. But at these levels, these gross oversold levels, I will tell you that the market in general is looking for any excuse whatsoever to start to buy because there's so much cash on the sidelines. I don't know what that news story will be, but I'll give you some examples. If it comes across the wire that the Ukraine war is over and Russia pulled out, that's an excuse to buy. If the Fed starts to make comments that it looks like everything we've done is working and we're going to start to slow our interest rate increases, that's an excuse to buy. If in the next Fed meeting, the Fed raises rates 50 basis points instead of 75 basis points, which they have over the last 3 meetings, that could be an excuse to buy. But the market at these extreme oversold levels is looking for something, anything to cause it to want to snap back. Okay, I hope that helps as well. We are still in, I always look at the primary wave. There's these first 2 initials, it's down, and the due is down, that's one of them, and our confirmed call is down. So everything is still in kind of a down phase. Now, I told you last week that I was starting to buy bear market investments. And I bought the S&P 500 one-time bear, and I bought that. And right now, let me just show it to you. Bear with me. Here we go. And let me move this chart over. So here is that investment that we bought, and it goes up as the market is going down. And today I raised our stop. Our stop was down in here. Let's see, it was at 1710. And now it's up here, it's at about 1721 or 22. And as the days go by, if the market keeps going down and this investment, which is inverse, keeps going up, we will just keep raising those stops, okay? That is the first one that we purchased. Now, today, let me go back here. Remember that the S&P today closed below that low. Well, if I go to the NASDAQ 100, it also closed below its June low. So I will probably, if all things being equal and depending what Monday looks like, I may be adding this symbol, which is PSQ, which is the same as the one we're already in, except for it's on the NASDAQ 100. Okay, and then that will be a second investment to the downside. Once this first S&P 500 one-time inverse ETF gets to a stop level that is above the cost basis, and I can show you where we track that. That is right over here. So here's the investment. We made it on 9/27. There's the symbol. The type is S&P 500 one times bear. I purchased it at $17.66 a share. Today, I raised our stop to $17.22. And what this means is if this stop gets really close to or above 1766, let's say it gets to 1770, that means that we cannot lose money on this trade because we would be stopped out above our purchase price. When that happens, or we're really close to that, I just told you that I was going to add a NASDAQ inverse bear market ETF. I'm going to add a second S&P. There are multiple S&P ETFs that do this. There's only one NASDAQ that is one for one that I like. It has a lot of volume. It's easy to get in and out of. That's important too. I mean, I have in my book, I have 31,872 shares of this. You may have 100 shares or 1,000 shares or 3,000 shares, but in total, I traded 31,872. So I have to make sure that any security we buy is liquid, so it can handle size, so we don't ever move the market. So in any event, I know that was a little bit confusing, but we have one S&P bear. We may be adding on Monday, depending on market direction, a QQQ bear. And as we get closer to our cost basis on that first S&P, we may have another symbol. It's SH. So we would have two. It's 5% of the portfolio in each one of these, maximum 15%. I won't go over 15%. And you may ask why. Even if we were 100% in cash, which we will be from now on, because we're not going to carry these defined outcome ETFs inside a bear market. So let's say we were completely in cash. And we would have possibly 15% in these bear ETFs. Now, why not 50%? It's because of the nature of bear markets. And this bear market is not acting like a normal bear market. Normal bear markets are very fast going down, and they're much faster than bull markets. And their duration is normally weeks to months, a couple of months. We're 9 months into this one. So if the reality is looking back over 20 years, they're very short term. We don't want to have 100% of our investments in these downward. We'll be fine. We will be making money when we don't have the defined outcome ETFs in there. We'll be making money on the downside, but I think it's prudent to stop at 15%. Now, for group one, you will also have the other things. You'll have the 21-day S&P that can trade to the downside, the 7-day S&P that can trade to the downside, the stock options that can trade to the downside. You'll have much more. But group two, who's primarily not doing most of those things, you can if you want, but primarily not, we will just have these bear market ETFs. So I do hope that helps. So that's the story. I wish I could paint a pretty picture for you. I don't have a pretty picture for you today. I just have the reality, and that's what charting does, is it tells us what's actually going on in the market, not what we hope is going on. But I guess you always have to be an optimist, and I hope that this was one day break and that Monday we're back on top. I'll let you know if that's the case. But when it comes to management, we have to see what is, not what we hope is. Okay, and I hope that makes sense. In a future video, I got a question the other day that said, it seems like all you do is cover technical analysis. Do you even use fundamental analysis when you buy stocks? Well, we haven't been buying a lot of stocks in this bear market, so I haven't talked about that, but I am going to do in a video the fundamental side of stock selection. We don't buy stocks that have bad fundamentals, but I'm going to show you how we calculate that. There's a lot of data that goes in. We absolutely use fundamental analysis, but technical analysis is more of the tactical aspect of trading. But yeah, so, and again, it was a great question. I am going to cover it in a video. If you have a thought or a question that you would like me to cover in a video, just let me know, and I'm more than happy to do that. So that's where we are today. We'll see what happens Monday, maybe adding some more bear ETFs, just not sure yet, and we'll have to wait until see what happens. But try to have a good weekend, and I will be, this bear market will end. Let me end this video by saying that this bear market will end. Bear markets don't go on forever. This has been a very long bear market. This has been, they're calling this the worst year in the last 52 years, over a half a century. This is bad, but it will end. They all end. And when they end and they turn, I keep telling you this, and you will see it, when, especially with this bear market, they go up so fast, it's blinding. So hang on, this is going to end, and we are going to get a piece of good news, and it's going to trigger probably trillions of dollars to come back into the market, and we will be very happy for that. And then after we go into a new bull market for the next few years, that's great. If we ever go into another bear market, which of course we will, usually they're short term, we will primarily be in cash, so we won't have this heartburn of seeing our account values fluctuate. So that's a story. Hope you enjoyed this. Please call me if you need me for anything. I'm always here, and I'll talk to you soon. Bye-bye.